Good day, and welcome to this brief update on the Momentum Focus Fund of Funds for the first quarter of the year. 2023 has been off to a volatile start, marked by ongoing uncertainty over the US economy, inflation, and interest rates. At the start of the year, most investors were anticipating a weaker US economy, which would in turn lead to lower inflation and a subsequent end to the Fed's interest rate hiking cycle. This outlook boosted market sentiment early during the quarter. However, markets took a turn in February as strong economic data and higher inflation out of the US surprised markets, leading to a sell-off in bonds and equities. The US Federal Reserve hiked rates by a further 25 basis points in March and indicated that it would continue to raise interest rates to contain inflation, adding to the market anxiety. March also marks exactly 1 year since the Fed's first increase in interest rates, in what has become the fastest and steepest tightening cycle in over 40 years. The federal funds rate is now sitting at 5%, in contrast to just 25 basis points in March 2022. Volatility and uncertainty in global financial markets continued as a banking crisis, triggered by the collapse of Silicon Valley Bank and the takeover of Credit Suisse by UBS, rattled investors and prompted central banks and governments to intervene to prevent a spillover into other sectors. Central banks faced the difficult decision between fighting inflation and stabilizing the banking system, leading again to expectations of a potential pause in rates and ultimately lower interest rates in some regions. Despite these challenges, the US economy showed signs of resilience and growth, leading to an upward revision in its growth forecast for 2023, along with other key economies such as Europe. In the US, the equity market delivered positive returns for quarter one. The tech-heavy Nasdaq delivered 17%, the S&P 500 returning 7%, and the Dow Jones up by nearly 1%. Overall, developed market equities outperformed emerging markets. US Treasury bonds also saw a large drop in yields, but some global equities still outperformed bonds. On a local level, the South African Reserve Bank raised interest rates by 50 basis points in March to curb inflation, which has reached 7% in February. The hike was much larger than expected and boosted the rand, but also reflected the weak economic growth and load-shedding challenges of our economy. Forward markets are now pricing in a further 50 basis points hike for 2023 before the SAR pauses and potentially starts cutting rates again. Our GDP also shrank by 1.3% during the fourth quarter of 2022, and Treasury lowered its growth forecast for the next 3 years. S&P Global also downgraded the outlook for South Africa's credit rating from stable to negative, citing the ongoing power crisis and a fragile economy. Locally, the FTSE JSE All Share Index, or the ALSI, delivered a positive return of 5.2% in quarter one. The ALSI was supported by strong performance from industrial counters, which returned 13.6%, driven by the robust consumer demand and e-commerce growth. However, the more locally focused CAPS Swix index returned only 2.4%, reflecting the challenging domestic environment. The SA property sector remained under pressure, with the All Property Index returning negative 4.8% in quarter one. The sector faced headwinds from low economic growth, high vacancy rates, rising operating costs, and regulatory uncertainty. SA bonds outperformed cash, with the FTSE JSE All Bond Index, or the ALBI, returning positive 3.4% in quarter one, while cash returned only 1.8%. SA bonds benefited from higher real yields and an improved fiscal outlook. However, the rand weakened against major currencies, losing 4.7% against the US dollar over the quarter. For the 3 months to end of March, the Momentum Focus Fund of Fund range returned between 3.6% and 3.8%, broadly in line with their strategic benchmarks. Within the local equity market, the cross-sectional volatility amongst individual stocks remained high and has not directly rewarded the momentum, value, or quality investment styles over the recent quarter or 12-month period. As an investment house, we favor these styles, and we believe this experience is cyclical and should reverse over the full market cycle. Despite this, the local equity blend within the Momentum Focused Fund of Funds had a reasonable quarter, but trailed the CAPS Wix index by 1.1%. Over the 1 year to end of March, the equity blend returned positive 1.4% ahead of the benchmark. Looking now at other mandates within the funds, we saw positive absolute returns from local cash and fixed income mandates, with the flexible fixed income fund adding 2.7%, slightly lagging its Alby benchmark, which delivered 3.4%. The Momentum Diversified Income Fund and Momentum Enhanced Yield Fund both added outperformance for the quarter. Moving on to global asset classes now, we benefited from the brief rally during the quarter, coupled with a late depreciation of the rand, to deliver strong absolute returns in local currency terms. During quarter 4, we changed the Global Developed Market Equity mandate from the Momentum Global Equity Fund to the Momentum Global Sustainable Equity Fund, which offers a lower tracking error to the MSCI World Index. The fund contributed 11.9% for the 3 months in rands, just shy of the index, which advanced by 12.5% as the Momentum style allocation detracted. In addition, the Momentum Emerging Markets Equity Fund added 9%, outperforming its benchmark of 8.5%, benefiting from strong stock selection, particularly in Chinese tech counters. The newly introduced Momentum Future Trends Fund also added 11.7%, outperforming its benchmark return of 9.5%. In terms of positioning, we went into the quarter with the view that local assets are better positioned for the prevailing economic environment, with a strong valuation underpin adding to this view. However, the escalating challenges facing the local economy, mostly in the form of load shedding, has dampened this view somewhat and is thus reflected in our overall cautious positioning. We remain bullish on local nominal bonds and have been adding to our global defensive exposures when the currency provided opportunities. As always, however, the funds remain purposefully diversified at an asset class, strategy, and mandate level, and well positioned for the current market environment. Thank you for your attention.